All right, let's talk about the global economy in 2025. It was a really fascinating year, and to be honest, a pretty tense one. Because while everything on the surface might have seemed okay, underneath, some major cracks were starting to appear. So let's get right into it.
This quote just nails it. It really gets to the heart of what we're going to break down today. It's all about this fundamental tension, this push and pull between the strength we were seeing in some places and the real weaknesses that were popping up everywhere else. It was a year that just seemed to contradict itself.
And here it is, the headline number that really framed the whole conversation. According to the IMF, global growth for 2025 landed at about 3.2%. Now, that number might not sound all that dramatic, but as we're about to see, it was both kinda modest and incredibly fragile. So let's start peeling back the layers on that 3.2%, because, a single number almost never tells the whole story. What it was hiding was a much more complex, much more fractured picture of the world, where different countries started having wildly different economic experiences. And it looks like that fragility isn't going anywhere fast, with projections pointing to a little slowdown, down to 3.1% for 2026. Now, the good news was that, globally, inflation seemed to be calming down. But even that average number is a bit misleading. The reality was, some countries were seeing prices cool off, while others were still getting hit with some pretty intense pressure.
And if you really want to see this split in action, all you have to do is look at the world's economic heavyweights. I'm talking about the United States, China, and India. Each of them took a remarkably different path in 2025, and that created all sorts of new tensions in the global system.
Okay, so what's so interesting here is the story of the U.S. economy. It was like a tale of two economies in one. On one side, you had these powerful engines, like huge investments in tech and AI, that really cemented its role as an innovation leader. But at the same time, all that progress was being held back by a lot of policy uncertainty and the economic drag from protectionist tariffs. A real push and pull situation.
Meanwhile, over in China, they put up what looked like a pretty solid growth number, around 4.8%. But the real story there was brewing just below the surface. You had these major internal pressures building up, from long-term issues like an aging population, those demographic headwinds, to big struggles with their own industrial production. It really cast a shadow on where things were headed.
And then you have India. This is where that story of divergence gets really clear. While the US and China were wrestling with their own complicated problems, India just popped out as the clear, shining star. It actually overtook Japan to become the world's fourth largest economy. It had this almost perfect Goldilocks thing going on. Really strong growth paired with low, totally manageable inflation.
So, with the world's biggest economies all on these different tracks, the big question is, how did the markets react to all this, right? Well, all that tension and divergence created a really complex, tricky environment for investors. And the way different assets performed tells a fascinating story of its own.
I mean, just look at this chart. It tells you pretty much everything you need to know. Yeah, stock markets saw gains overall, but that performance was super narrow. It was almost completely driven by a massive boom in just a handful of artificial intelligence stocks. Meanwhile, the broader market, and especially commodities, they were way behind.
And outside of that AI-fueled stock craze, the rest of the market was just defined by uncertainty. Commodities were all over the place, bonds were fluctuating like crazy as central banks tried to figure out what to do, and all of this chaos just pushed more and more investors towards safer, more traditional assets.
Okay, so let's pull all these threads together. What do all these fractures from 2025 really tell us about the road ahead? In this last part, we're going to look at the key risks and maybe some opportunities that are shaping the outlook for 2026.
Now, to help frame what's coming next, some researchers look at tools like the Benner cycle. And look, this isn't some crystal ball that can predict the future, not at all. But it is a theory that tries to use historical patterns to spot these long-term economic phases, and how it reads 2025 is pretty telling. And here's the key takeaway. The cycle sees 2025 as this transitional period that actually made things more fragile. It was a time that was defined by huge waves of speculation, which, hey, sounds a lot like that AI stock boom we were just talking about, right? And all of that was just setting the stage for whatever comes next. So here's the bottom line. All those trends we saw in 2025 point directly to the major risks waiting for us in 2026. We're talking about rising geopolitical tensions, the chance of even more trade restrictions, the constant threat of that AI boom maybe turning into a bubble, and of course, the ongoing friction from the world's biggest economies all trying to do different things at once. And all of this kind of leaves us with one final thought. The fractures of 2025 are a huge reminder that economics, it's not just about numbers on a spreadsheet. It's really a reflection of all of us, our collective decisions shaped by politics, supercharged by technology, and totally disrupted by conflict. So looking ahead, which of these cracks do you think will get even wider in 2026, and which ones just might start to heal?